What's up, friends? No, I'm here. Just getting it on. Testing, testing, testing. Oh, there it goes. Now it changed screens. You guys can hear me? Perfect. What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. If you are new here, basically over the next 20 to 40 minutes, I'm going to be doing fundamental and technical analysis, giving you breakdowns and trade ideas on gold, GBPJPY, GBPUSD, EURUSD, USDCAD, and US30. We're going to look at key fundamentals in play first, understanding market sentiment and reactive events, understanding what economic and pre-planned events we have on the table, and then doing our individual analysis across these pairs. Let's dive right into it. recent fundamental points and fundamentals holding the most weight. If you've been following along capital hungry market updates, higher time frame analysis, and so forth, you will understand that we have been playing the macro information advantage of central bank policies holding the most weight, and more specifically looking at the Federal Reserve and their active rate hike cycle. We understand the Federal Reserve's active rate hike cycle is starting to end the free money decade, having less investment in institutional activity in the markets, overall seeing bearish asset classes such as gold, stock markets, real estate, crypto, and so forth, and US dollar domination. This is the main reason we've been playing gold sells for the last year, GU, EURUSD sells, US30 sells, USDCAD buys, and of course playing that dollar correlation. So the macro information advantage of central bank policies is still holding the most weight. Bank of Japan is dovish, keeping the Japanese yen very bearish, as confirmed by Bank of Japan's Kuroda. Japanese yen is hitting very aggressive, higher time frame lows in a very volatile fashion. We will have to keep in mind some reactive events such as the Japanese government currency interventions that can possibly be happening in the next week or two, even over the next couple of nights. The Federal Reserve is still extremely hawkish. We had robust labor market reporting showing that the US labor market, from unemployment rate dropping and NFP still being healthy, is strong enough to handle more rate hikes and continue the Fed's hawkish aggressive path. We also had a very high inflation reading showing that the Feds need to do more work to bring that inflation down, aka continue to raise interest rates, keep interest rates hiked for an extended period of time, minimum 18 to 24 months, and that their primary focus is that single mandate of inflation, not too worried about external impacts of dollar strength in other countries, just focusing on that single mandate domestic approach. Higher time frame structure is still being respected and validated. Gold higher time frame bears. GBPUSD, even though we're having some short-term upside moves, is still very bearish on the higher time frames. EURUSD very bearish. USDCAD bullish. US30 stock market index bearish as well. And now, besides the overall fundamental main catalyst of the central bank monetary policies, Bank of Japan keeping interest rates in the negative in their bond buying program going, Federal Reserve on the other side of the coin, hiking rates and keeping interest rates hiked for an extended period of time, focusing on inflation. One thing we have to keep in mind is reactive events such as currency, government, and central bank interventions that can create some short-term pullback plays against higher time frame trend. We've seen Bank of England do bond buying amidst the active rate hike cycle. We've seen Janet Yellen from the US government promote and push other countries to purchase government bonds from the US side. We've seen the Japanese government do some currency intervention in the short term to bring up yen strength. All of those are short-term reactive events that get faded out in the overall monstrous rate hike cycle by some of the major central banks, with main focus being the Federal Reserve, obviously, as they impact and are the cartel of the currency of the US dollar, and the US dollar being your world reserve currency and global business currency. Some key news events. We can see US dollar hit fresh 32-year highs against the yen. This is showing us two things. The one-sided volatility of the Federal Reserve rate hike cycle against the dovish Bank of Japan, and the impulsive weakness in the Japanese yen. Hence, we saw some great GJ buys take place. If you've been following capital hungry market updates, higher time frame analysis, you've also been in a bullish GJ bias for months and months now, just adapting to pullbacks and then continuing the buyer sentiment. This morning, we did see some short-term dollar weakness and an aggressive gold pullback play that was primarily induced by some weak US economic data regarding the Fed's business conditions reporting, coming out at a minus 9.1 versus a minus 1.5 in the previous month. But that move got priced in, and we can already see gold turning bearish throughout the day and dollar buyers slowly starting to come back into the scene. In terms of GBP individually and why we saw GU do some deeper pullbacks and GJ continue so bullish in aggressive fashion, we're seeing more optimism from the new UK Finance Minister Hunt, where they're reversing all of their tax measure plans and going to be focusing more of a macro approach. For those of you who don't know, Liz Truss came in guns a-blazing and really caused a lot of uncertainty and a lot of political unrest as she was coming in with all of these policy plans to cut taxes for the working class, increase taxes for corporations, without actually having the logistics to actually stand behind those words. We can see that UK Finance Minister Kwarteng got sacked and fired just after being in position for maybe a week or two, pretty much taking the fall for Liz Truss. Other than that, we are seeing short-term optimism in GBP on top of a Bank of England rate hike cycle, which can keep GJ very bullish, and see some deeper pullbacks on GU before continuing overall bearish again. In terms of market sentiment, we're still looking to play US dollar domination in bulls, primarily induced by the aggressive Fed rate hike cycle, still strong and robust labor market data, on top of very high inflation, with the primary focus of the Feds being to bring down inflation. Japanese yen is still very bearish on the Bank of Japan's dovish sentiment, keeping interest rates in the negative in an unlimited bond buying program. And global equities are still relatively soft and bearish, not seeing any major sell-off, but just sitting at previous intraday lows. When we look at market sentiment, we can see global equities across the board here. Yes, they're seeing a bit of bounces, but we're just having a pullback in overall bearish market structure from intraday lows being printed. Overall, stock markets are still in a bear market across the board. As long as rate hikes are holding the most weight, recession scares still continue to develop, and we see less investment activity from an institutional perspective as we have high interest rates, less institutional lending going on, very high prices on equity markets from a historical perspective as well. When you're looking at market sentiment confirms, you can also see dollar is still very bullish, just sitting at its higher time frame highs, having a pullback phase for the new week. So even if dollar was to come and retest 110 again, or just start to bounce from 112, still very bullish on the higher time frames. We can see Japanese yen very bearish individually. This was the last time the Japanese government did currency intervention, giving a short-term upside spike. And the volatility index still just sitting at intraday highs around 34. When we're coming to look at gold over here, for anybody who's been following the market updates and higher time frame analysis, we have been playing this overall bearish market structure. Federal Reserve rate hikes holding the most weight, sellers consecutively printing these lower lows. As these lows get printed, you enter secondary phases of market structure, seeing the sellers liquidate positions, buyers jump in the short term, and creating these pullback phases. These pullback phases go to retest better sell zones, where once you get the confirms of buyer exhaustion on the higher time frame, you overall make your way to the downside to revisit the lows and potentially dig even lower. As we had a high inflation reading, still had very strong labor market and US dollar domination, you can see with the analysis given ahead of time, 1720 sells have been running absolutely fantastic. We roughly came to revisit previous lows and seen in bearish market structure here, and still maintain the integrity of sellers in control, US dollar domination, and of course the Federal Reserve rate hike cycle holding the most weight. When we're zooming in even more here, you can see very strong bearish intraday market structure that's starting to form as well, where even if we get some intraday pullbacks to revisit 1657s or 1660s, we're still expecting us to continue overall bearish. Bearish price action, bearish market structure, bearish fundamentals with the Fed rate hike cycle and US dollar domination, and Feds further cementing their hawkish monetary policy plan. We just want to understand what economic events we have on the docket before we jump into that individual analysis and trade ideas across the pairs. Overnight tonight during the London session, getting closer towards Asian session close and 5 a.m. Eastern, we have some German economic sentiment reporting. German data and overall Euro data has been relatively very weak as the Eurozone has been in an active recession. I'm still expecting this German data to be very bad, leading to some short-term continued weakness on Euro. When we're looking at North American trading session from 8:15 to 9:15, we just have some minor reports. 8:15 with CAD housing numbers, not going to have that much impact. 9:15 with industrial production monthly, and then 9:15 with the capacity utilization data and some more housing data for the US economy at 10. Housing figures aren't going to hold that much weight. It's very well expected that real estate market is starting to drop as house prices are going down with active rate hikes and less investment activity. industrial production potentially showing a rebound, this is going to be the main report in focus. If industrial production is showing rebounds coming out of negative territory, that can lead to further sells on gold and dollar strength coming back into the table. Other than that, then we have some of the more important data for China later in the Asian session tomorrow, which can come out anytime this week, roughly guesstimated at this time between the 17th and 21st of October. Main focus points for data overnight is just the German sentiment reporting, which is going to be very bad, and then the industrial production for the US at 9:15 a.m. Eastern, which I'm expecting to show some type of rebound, which can further support gold sells, dollar buys, and playing the higher time frame bias. When we're looking at central bank and political activities, we want to keep in mind we still have some IMF speakers going on actively, and we do have Federal Reserve speakers tomorrow. Federal Reserve speakers tomorrow afternoon that can bring further hawkish sentiment, talking about rate hikes, bringing down inflation, and keeping rates hiked for an extended period of time, which can also bring back US dollar strength, gold bears, and so forth. Now, when we look at the anatomy of gold here on the higher time frames, we have very, very beautiful bearish market structure and still higher time frame low targets to revisit the 1620s. Every single time we have a significant low printed and a pullback phase, all we end up doing is creating a very nice range to play once the pullback phase is completed. If you guys go and back test any of the trades I've been taking over the last year, majority of the times I'm playing pullback gold sells. We wait for the pullback to take place and complete and fade out some of that pullback structure. We wait for the confirms of exhaustion and sellers retesting better sell zones of interest. Here was the 1720s, here was the 1800s, here was the 1870s. And then as soon as you have your dollar domination, more rate hike cycle confirms by the Federal Reserve, still robust labor market data and other figures that are supporting the Fed's hawkish sentiment, all we do is end up having downside to revisit those lows and also potentially continue lower. So I'm still expecting us, whether we have a pullback or not, to be filling this range and coming all the way down to 1615 lows, and then still potentially continuing bearish to have sellers print even new lower lows. When we're diving down into the price action, we have very, very clean intraday bear structure forming here as well. Very strong bearish price action with this new weekly candle already creating a pretty aggressive wick to retest this liquidity zone and range lows, and closing relatively weaker compared to the bearish engulfing candle we saw before. If we see the new daily candle just make a bit of an upper wick, not fully correct this downside move, I'm expecting then us to flip bearish or the break below these daily lows, diving into the 1620s and 1615s. Higher time frame bearish structure, US dollar domination, bearish price action, sellers in control, Fed's hawkish rate hike cycle holding the most weight on top of the economic data further supporting that sentiment. Now, bringing that information together to the table, you can see we do have some exhaustion and failures to break around 1642. Breaking below 1642 here would be the safest sell side play, digging into the 1620s. But other than that, for the new daily candle setup, even if we get a pullback roughly to 1660 and 1657, breaks below with this daily candle setting up and flipping below 1648, and breaks below 1642, I would be looking for gold sells. Higher time frame bearish, US dollar domination, bearish price action, Fed rate hike cycle. And we've already seen a lot of sell side orders generated from these pullbacks and what we saw with the CPI data, the NFP data on the higher time frame, liquidity generated, and for the new week, this pullback that we've already seen up into the 1665s and 1664s. Okay? This is my main bias, main expectations. Pullback to retest structure, 1657 to 1660. Just flip bearish below 1648. Break below 1642. continue sells. The only way I can see buys is we would need a fundamental catalyst for buys and breaks well above 1680s. We would have to break these sell side liquidity zones, break this bearish structure, completely correct this downside move, and have a fundamental catalyst that can have enough weight to break that overall market structure as well. Even when we've had things like bad economic data reports like we had today, or any type of price setups with short-term fear, whether it's currency interventions or bond buying by central banks, majority of these moves just retest better sell zones, get faded out, and continue the overall bear structure. Okay? Now, when we're looking at our other dollar pairs, such as GBPUSD, GBPUSD on the higher time frames is still extremely bearish, but it would not be out of the ordinary at all to get very aggressive pullback phases before we continue down the higher time frame sentiment. You can see it is very common on these dollar pairs as significant lows are printed by sellers to see these pullback phases before continuing bearish. We also have to understand that GBP individually has also had a little bit of short-term optimism with the political promises coming from these new parties within the UK. When I'm looking at the overall structure of GU here, we're just having a pullback phase where this pullback phase could easily go to retest 1.16 before turning bearish again on the higher time frame. GBPUSD, when we're looking at it on the higher time frame, is still extremely bearish in market structure, extremely bearish in price action, but getting pullback phases is completely normal. And the pullback phases are always in relation to the downside move. At the start of October, we had extremely impulsive downside. Seeing a pullback phase to even retest bearish market structure, previous significant lows in liquidity zone around 1.16 is not out of the ordinary at all before still continuing bearish on the higher time frame. It is very common to see these secondary phases of market structure in pullbacks. Dollar is just having some short-term weakness on top of having GBP with some short-term political optimism impacting it individually, and some more rate hike confirms from the Bank of England from last week, just creating this deeper pullback from these lows after such impulsive downside. Overall, when you're looking at the structure, as long as dollar stays bullish on the higher time frame, we don't break above these previous significant lows and we retest here, all we're doing is creating a beautiful higher time frame range to be revisiting these previous lows. Exactly like every time these pullback phases have been gotten faded out before. Right? So bringing that information together to the table right now and looking at GU on the intraday time frames, if we break above this current rejection point, I can see short-term upside plays to retest better sell zones around 1.155 and 1.16. Otherwise, if we make an upper wick and start flipping bearish, just jumping back into the higher time frame sells. Green box being a short-term upside buy play up to retesting better sell zones. So that would be 1.145 pullback buys to retest better sell areas at that daily retest of bearish structure and previous liquidity zone. Otherwise, if this new daily candle makes an upper wick, flips bearish back below 1.135, 1.13, I would just be jumping back into the higher time frame sells. Very bearish structure on the higher time frame. Dollar still bullish on the higher time frames. We're just in this pullback phase that we want to confirm we can start to break out of to jump back into the bias. EURUSD, same type of idea. EURUSD is just having a pullback phase from significant lower lows being printed. But the overall bearish market structure is extremely strong across time frames. Whether you're looking at from the start of the new year period, or whether you're looking at from start of last year, or whether you're looking at the start of this year, we've been in extremely bearish market structure. And it is common to get these aggressive pullback phases. Sellers print consecutive lower lows on dollar domination, Eurozone weakness, Eurozone just recently coming out of negative interest rate territory. You have these short-term pullback phases that retest better higher time frame sell zones of interest. And then overall, you still end up respecting bearish market structure, flipping to revisit those lows and continue even more bearish. We can come up to 1.10 flat and still be extremely bearish when you're looking at EURUSD, understanding market structure, secondary phases of market structure, and playing this short-term pullback up until better sell zones. So when we're looking at current information here, last daily candle closed bullish engulfing, canceling out that bearish move, and we can easily still have pullbacks to this liquidity zone in previous lows marked out here, as well as key rejection points around 0.995, 1.0 flat. I'd be looking to play the buys in the short term up to there until we can retest and show rejection signs at those sell zones, or we would need to be canceling out, coming back below that bearish candle to see the higher time frame sells. Bringing that information together on the intraday time frames here, if we just have a minor daily lower wick and we hold above this zone, I can still see short-term pullback buys to better sell zones on the higher time frame here, with green box being buy areas, red box being areas where I'd start to look for sells. Otherwise, if we snap back below the range here, and especially come below 0.97 key level, cancel out that bullish engulfing daily candle move, I would just be jumping back into the higher time frame sell bias. Let me move my camera here. Okay. So short-term potential buy pullbacks, if dollar just has some continued short-term weakness, we hold above 0.985, and then I take those pullback buys to retest those better sell zones shown on the higher time frame daily and intraday time frames. If we don't have this move take place, I'd be jumping back into the higher time frame main bias sells, back below this range and sell zone, canceling out this upside move below 0.978, 0.974, 0.97 flat. So both GU and EURUSD are very similar, where we can see some short-term pullback buys up into better sell zones, or just jump back into the sells if we get confirms of canceling out these upside moves. Okay, USDCAD. USDCAD is the inverse. Dollar is the primary in the pair, and the secondary is your risk currency, being the Canadian dollar, where oil has been more bearish, keeping the Canadian dollar more flat. US dollar domination with the active rate hike cycle by the Feds holding the most weight. Bullish market structure, buyers printing higher highs, but very common when you look at how USDCAD behaves to have these aggressive pullback phases as you're making your way to the upside. The inverse of GU and UCAD in understanding the behavior and movement. I could easily see pullbacks to 1.35 and still be maintaining the integrity of higher time frame bullish market structure, or coming back above 1.38 further buys. Bullish market structure, bullish fundamentals, Canadian dollar weak with Bank of Canada sentiment priced in, oil still relatively bearish as well. Bringing that information together with key zones and price points of interest, 1.364, 1.355 pullback area buys, break back above 1.374, break above 1.38 would still be UCAD buy areas. Now you can potentially take some short-term sells to revisit these buy zones, but understand that you're counter trend trading against the higher time frame, and not to get married or stuck to that bias, understanding that you're just playing a short-term pullback phase to set up better buys on the higher time frame with dollar domination. Understanding and coming here and looking at equity markets. Overall, the stock market has been in a bear market since the start of the year. What's very common is retard buyers get trapped every time you have these delusional optimistic rallies from sellers printing consecutive lower lows. Multiple things happen when you have these pullback phases. One, greedy stock market buyers are trying to get as many gains as they can. Two, buy side liquidity gets trapped, so there's enough liquidity for sellers to make another leg down. 3, you just have these short-term pullback phases to retest better sell zones until you overall still end up continuing bearish, respecting market structure and of course the active rate hike cycle by the Federal Reserve. Now, when you look at these bear market rallies, it's very common that you can see them extended for a period of days and weeks. We can't see that when we're looking at the current structure of US 30 unless we start to break well above 3,500. If we break above 3,500, we'll have another useless delusional bear market rally to trap retard stock market buyers before still continuing bearish again on the higher time frame. There's zero reason fundamentally for stock market upside. Interest rates are still going up. The interest rates are going to be up for 18 to 24 months. Every person and every retard like AJ here has said buy the dip, every single dip that's been created. And they said we're going to go into all-time highs again. And guess what? Every time those retards get trapped and sellers come and sweep them out with them being nothing but exit liquidity for the whales. Same type of thing here. Even if we get one more squeeze, 500 points, we're just going to end up fading it out on the macro information advantage. Global recession scares are developing. Whales have already cashed out from all-time highs. There's an active rate hike cycle by the Federal Reserve. There's less investment activity from an institutional perspective with higher interest rates. There's way less buy-side volume. Bearish market structure. Sellers in control. We're just having a pullback from new lows being printed. Bringing that information together to the table here. Right now, we're still respecting this overall bearish market structure on the intraday time frames, and I can't see any deeper pullback phase unless we're trading well above 3,500. If we have an upper wick and dollar domination come back into the scene, I would be looking for continued sells back below these price points. Upper wick created, failed to break 3,500, 3,300 sells, 30K sells, 29,600 sells. I can only see any type of short-term US 30 buys to retest better sell zones on the higher time frame, really coming from 3,500, which I would just see retesting 31,500 before turning bearish again. Again, US dollar domination in majority of asset classes from real estate, crypto, gold, commodities, equities have all been bearish for the same fundamental reasons. Global stock markets are bearish. Interest rates make it less favorable for institutions to take out loans and invest that into the stock market. Less institutional activity, less investment activity. These pullbacks are just buyers getting trapped, providing exit liquidity and more volume for the sellers to continue legs down. Last but not least, GJ. GJ on the higher time frames is extremely bullish as we've been playing the macro information advantage of a dovish Bank of Japan and a more hawkish Bank of England. We had major price grabs and liquidity grabs at the start of the quarter with some price setups coming down to 150 demand zone and also holding above 160. We're also starting to break above last significant intraday and higher time frame higher highs. I would be looking for pullbacks of these highs and continued bullish plays. Yen is impulsively weak when we did our market sentiment analysis. Bank of Japan is still dovish, keeping interest rates in the negative. We have optimism in GBP from UK political plans. Bank of England still keeping rate hikes active, with any bond buying just being some short-term pullback plays, not breaking higher time frame bullish market structure. You can go look at Capital Hungry previous market updates. You can go look at the higher time frame analysis. We've been calling GJ buys literally for a year and a half, 2 years. We've been playing gold sells for the last year. We've been playing GU sells for the last year. We've been playing EURUSD sells for the last year. We've been playing stock market sells for the last year. There's zero reason to shift out of that from a fundamental and real world perspective. Anybody telling you otherwise is nothing but ego-driven trader trying to call tops and bottoms with zero economic and fundamental understanding and a retard that keeps getting trapped in the market. When I'm looking at overall GJ structure, very nice impulsive movements here. If we can get pullbacks to, of course, 167.5, retest of roughly previous highs in 168, I'd still be looking for continued bullish buys on GJ. Break above these high buys, break above 170, GJ buys. And scaling back up accordingly. Okay? Pullbacks to 167.5, 168 buys, break above 169.5, break above 170, continue GJ buys. Bullish market structure, bullish price action, new higher time frame highs being printed, and of course, Japanese yen impulsively weak, Bank of Japan dovish, Bank of England more hawkish with active rate hikes. No reason to fight this trend, no reason to fight the fundamentals. People like AJ are retards that keep losing in the market overall and have zero results to show anybody. You don't want to be a retard like that saying the stock market is going to all-time highs in an active rate hike cycle. Let me show you an example. AJ was the type of retard in 2008 here. This is the 2008 stock market crash. AJ was the retard where every single time a dip was created, he thought we're going back to all-time highs just because we're having pullback phases. But what happened during the 2008 financial crisis? Every single pullback phase got faded out and we had a market crash take place. AJ is a retard. You don't want to listen to retards like this who don't understand pullbacks. Right? So you don't want to understand retards like this that don't understand market history, economic cycles, fundamentals, and so forth, and think every single pullback is a bottom being put in. No, those are just pullbacks to trap retard buyers like AJ with a retard name like that himself. All right, everybody. So very nice, informative, value-filled market update and trade ideas webinar. We went through key fundamentals in focus and what's holding the most weight. We went through key news headlines that have been over the last couple of sessions. We went through market sentiment analysis, looking at global equities, Japanese yen, US dollar individually. We went through what economic events and political events we have on the table. And we went through higher time frame and intraday analysis as well as trade ideas across the pairs. You can always rewatch this as you wish. It's going to be saved and uploaded. Everybody take care. Have a great day.